Welcome to the Deep Dive. Today, we're jumping right into the Q2 2025 earnings call from MPLX. It literally just wrapped up this morning.
That's right. And it's an interesting one.
Definitely. If you just caught the headlines, you might have seen some, well, maybe slightly disappointing financial numbers. GAAP EPS, revenue, both missing estimates.
Yeah, the kind of thing that can make the market twitchy.
Exactly. But what really caught our eye and what we want to unpack for you today is how the story this quarter goes way beyond those surface figures.
It really does. It's much more about ambitious strategic moves, a bigger vision.
Right. A vision that could really change MPLX's trajectory. So our mission here is to, cut through that initial noise and pull out what really matters.
Let's do it.
Okay, so let's lay out those key numbers quickly first, just to set the scene. MPLX reported GAAP EPS, that's their main earnings per share figure of $1.03. And revenue came in at $3.003 billion. Like we said, both of those were actually below what analysts were expecting.
Which, on its own, might sound like bad news. But here's the interesting part we hinted at. The market's initial reaction wasn't panic.
No, it felt more like digestion. Like the market was processing the bigger picture, the strategic stuff, rather than just reacting to the miss.
Precisely. It suggests that the operational strength and the long-term strategy talked about on the call carried more weight than just those headline numbers.
So beneath that surface, what did we see?
Well, adjusted EBITDA, which gives you a clearer view of operational profit before things like interest and taxes that actually went up 2% year over year, hit $1.690 billion.
Okay, so operationally, things look solid.
Yeah, and distributable cash flow, or DCF, basically the cash they have to pay out to investors, that stayed really strong too, at $1.420 billion.
And they covered their distributions easily.
Very comfortably, a 1.5 times coverage ratio. So they generated 1.5 times the cash needed for those payouts.
That's a healthy buffer. And they actually increased the distribution too, right?
I did. A pretty significant jump, 12.5%, up to just over 95 cents per unit for the quarter.
Wow, 12.5%. That's substantial. And they did this while keeping debt in check.
Yep. Maintained a disciplined leverage ratio, 3.1 times net debt to EBITDA. That's comfortably below their target ceiling of 4 times. So financially, they look quite stable.
So even with the EPS and revenue miss, the underlying engine cash flow, operational profit, manageable debt seems to be running well.
Exactly. And that financial health is really what underpins their ability to make these big strategic bets we're about to talk about. It shows they're not just surviving, they're positioning for growth.
Okay, let's get into that strategic engine then, because this is where the call got really interesting. The absolute headline grabber was the Northwind Midstream deal.
Absolutely. That's the big one. A $2.375 billion cash purchase. That's important. It's a major sour gas system in the Permian Basin.
Expected to close soon?
Yeah, Q3 2025, so next quarter. And critically, they stressed it's immediately accretive to distributable cash flow. It starts adding to the pot right away.
And the returns look good.
Very compelling, actually. They're projecting a mid-teen unlevered return. That's the return before considering debt financing. And they valued it at about 7 times its expected 2027 EBITDA once the planned expansion is done. It's a pretty attractive multiple.
Okay, tell us about the assets themselves. What does Northwind actually bring to the table?
It's significant. Over 200,000 dedicated acres in the Delaware Basin, which is a key area, plus over 200 miles of gathering pipelines.
And you mentioned sour gas. That's different from regular natural gas, isn't it?
It is. Sour gas has hydrogen sulfide in it, makes it more corrosive, more complex, and frankly, more expensive to handle, requires specialized treatment.
Which means higher fees for processing it.
Exactly. Northwind brings specialized sour gas treating capacity, and they're expanding it substantially from 150 million cubic feet per day now, up to 440 million by the second half of 2026.
That expansion costs money, though.
It does. About $500 million in additional capital, but they said much of that work is already underway.
Strategically, how does this fit with MPLX's existing operations?
It's a perfect fit, really. It's right next to and complements their current Delaware Basin gas system. So it's not just adding assets randomly, it's expanding their core footprint logically.
And their security in the revenue.
A good amount. Minimum volume commitments, MVCs, cover about 80% of Northwind's revenue. Think of those as guaranteed payments.
Ah, okay.
And those contracts have an average life of 13 years. That's strong, long-term visibility. Plus, remember the sour gas complexity. That higher fee structure is key.
Any hidden upside?
Potentially. The deal also brings an extra 50,000 to 70,000 barrels per day of liquids. They explicitly said those aren't included in the initial economic projections.
So that's extra potential value down the road.
Exactly. Optionality.
Okay, Northwind is huge, but you said it's part of a broader strategy. What else is going on?
Right. This wasn't a one-off. They highlighted $3.5 billion in these bolt-on deals just this year so far.
$3.5 billion. So besides Northwind.
They also increased their stake in the Matterhorn Express pipeline by 5%, and they took full ownership of the Bengal NGL pipeline system. Small pieces, but they add up, strengthening the network.
And it's not just buying things, right? They're building, too.
Oh, yeah. A lot of building. They're on track with a $1.7 billion organic growth capital plan for this year, 2025.
$1.7 billion. That's a serious amount of investment. Where's it going?
Over 90% of it is focused squarely on their natural gas and NGL services segment.
Okay, so a clear strategic bet there. Doubling down on gas and liquids.
Definitely.
Right.
And that capital is funding some major projects. You've got the Secretariat processing plant coming online Q4 this year. That adds 200 million cubic feet per day processing capacity.
Which brings their total Permian processing to
a massive 1.4 billion cubic feet per day. Then there's the Bengal NGL pipeline expansion, boosting its capacity by 50,000 barrels per day by late 2026.
And longer-term projects.
Yes. Looking out to 2028, 2029, they're developing two big fractionators on the Gulf Coast, those separate NGLs, into products like propane and butane, and a large LPG export joint venture with 1AO.
So processing, transport, and export capability.
Exactly. Plus, they've upsized the Traverse gas pipeline. They're building another processing plant called Harmon Creek 3 in the Marcellus Shale region. It's a very comprehensive build-out.
When you put all these pieces together, Northwind, the bolt-ons, all this organic building, what picture does it paint?
It paints a picture of MPLX fundamentally transforming itself, moving from being seen maybe primarily as Marathon Petroleum's logistics arm, especially for crude oil,
right,
to becoming this integrated wellhead-to-tidewater super system for natural gas and NGLs. They're building the infrastructure to gather it, process it, transport it long distances, and get it to export markets.
Which allows them to play price differences between regions, arbitrage.
Precisely, and capture that growing export demand. It positions them quite differently from peers, maybe still more focused on older crude pipeline systems.
It's an ambitious plan. How are they managing the finances with all this spending?
They made a point of emphasizing their financial flexibility. Ended the quarter with $1.4 billion in cash. And importantly, they also paid back $1.2 billion in debt, senior notes.
So managing the balance sheet even while investing heavily.
Seems to be the goal.
Yeah.
And they're not forgetting shareholders amidst all this growth.
Yes, the returns. What did they say there?
They announced a fresh $1 billion unit buyback program. They've already bought back $100 million this quarter under it, $200 million total year to date.
Okay, buybacks plus that big distribution increase we talked about earlier.
Right. And they reiterated their commitment to that 12.5% annual distribution growth rate, stating it's well supported by what they see as durable mid-single-digit growth in adjusted EBITDA.
So it's a two-pronged approach. Invest heavily in growth, but also return significant capital to unit holders.
That's the message they're sending. Balancing act.
Okay. We've dug into the numbers, the strategy, the spending, the shareholder returns. Let's step back. What does this all mean for you, the investor, trying to make sense of MPLX right now?
Well, as we mentioned, the market's initial takes seem to be let's wait and see, digesting the strategy rather than panicking over the headline mess.
And how's MPLX performing compared to similar companies?
It's actually continued to outperform its main peer group benchmark, the Alerian MLP ETF, across different time periods. That suggests some sustained strength relative to the sector.
And the sector itself, midstream energy, is generally seen as pretty stable, right?
Generally, yes. It benefits from record U.S. energy production and those fee-based contracts we talked about, which provide pretty stable cash flows, less sensitive to commodity price swings than producers are.
But what's the mood among investors specifically towards MPLX after this call?
It feels a bit split, actually. You've got income-focused investors who really like the story. Attractive yield, around 7%, plus that strong 12.5% projected distribution growth. That's very appealing for income seekers.
Okay, that makes sense. What's the other side?
Well, you have some maybe more cautious investors, some hedge funds perhaps, who are looking at the sheer amount of capital being spent, the acquisitions, the organic growth, and worrying about potential leverage creep.
Meaning, could debt levels rise too much, especially if interest rates stay high?
Exactly. And related to that is execution risk. When you have this many large projects underway simultaneously, there's always a risk of delays or cost overruns.
So delivering on time and on budget becomes critical.
Absolutely. That'll be a key thing to watch.
What are the specific near-term milestones people should be tracking?
Definitely the closing of that Northwind deal, expected next quarter, Q3. That's a big one to get across the line. Then hitting the Q4 2025 target for bringing the Secretariat processing plant online.
And keeping an eye on competition in the Permian.
For sure. There's a lot of activity trying to get gas and liquids out of the Permian Basin, so ensuring they successfully build out their capacity and secure the volumes to fill it is crucial.
So summing up the strategic narrative here.
The story is transformation. From a marathon-centric crude logistics player to a diversified, integrated gas and NGL growth platform with global ambitions.
And the catalysts to watch for.
You've got a series stacking up. Northwind closing Q3 25, Secretariat startup Q4 25, the Bengal expansion and Harmon Creek 3 coming online in late 2026, plus those regular semi-annual distribution increases.
And external factors could play a role too.
Definitely. Things like approvals for new LNG export facilities, any changes to rules about flaring natural gas in the Permian, and of course global demand trends for LPG, all of those could impact MPLX's world.
Okay, now let's shift gears slightly for our This Is Not Financial Advice segment.
Yeah.
A reminder, this is purely for discussion and exploring ideas, not a recommendation. Always do your own research.
Absolutely. So thinking of that market reaction, the digestion rather than panic, it suggests maybe the market hasn't fully priced in the potential success of this big strategic shift yet.
Okay, so there might be an opportunity if they execute well.
That's the thinking behind this idea. It's a bit outrageous but plausible, as we like to say. I'm thinking about a bull call spread on MPLX units.
All right, break that down for us simply. What does that involve?
Okay, conceptually, you'd buy a call option for a future date, say January 2026, with a strike price a bit above where MPLX is trading now. That gives you the right to buy units at that price.
Got it.
But at the same time, to limit your cost and your risk, you'd sell another January 2026 call option with a higher strike price.
So you're betting the price goes up, but only to a certain point.
Exactly. You define your maximum potential profit and, more importantly, your maximum potential loss up front. It lets you play for significant upside if the market starts to really appreciate the value MPLX is creating as Northwind integrates and products like Secretariat come online and prove themselves.
So it's essentially a bet that the market will re-rate MPLX higher once these strategic moves start showing concrete results over the next, say, 6 to 12 months.
Precisely. It's a bet on execution, and the market eventually recognizing the growth story that might be currently overshadowed by the sheer scale of the investment.
Interesting concept. Again, purely conceptual, not advice.
Not advice, just an idea.
Okay, so wrapping things up. MPLX's quarter was really defined by this major strategic expansion push. Big acquisitions, big organic spending.
But balanced, they argue, by financial discipline and a strong commitment to returning cash to unit holders through those distribution hikes and buybacks.
Right. Resilient cash flows underpinning it all. Again, our discussion today is for informational purposes only. Please don't take it as financial advice.
Always do your own homework.
We'll leave you with a final thought to ponder. We keep hearing about the massive energy demand coming from things like AI data centers, the general electrification push.
The grid needs more power.
So think about this. How central could MPLX's growing wellhead-to tidewater gas and NGL system become in meeting that demand, shaping U.S. energy exports, and maybe even influencing global energy security over the next 5 to 10 years?
It's a big question. Their infrastructure could become increasingly vital.
Something to think about. We'd love to hear what stood out to you from this earnings call. Join the conversation. Let us know your thoughts.